So this is a video that I want to say that it's a video that I've wanted to make for a while. This is a video that I have not wanted to make because I don't want to jinx it. But it's maybe quite possibly the most important video training that I've ever done, because I'm going to reveal to you a strategy that I've used over the last year and a half, man, going on almost 2 years now, I guess, that has had a 100% success rate. Now, again, you got to take that with a little grain of salt, because any trading strategy, if you run it out into the future, if you extrapolate it out over enough trades, eventually has losses. But nevertheless, it is what it is. We are, I think, about a year and a half or so into this trading system, and so far, again, big knock on wood, not a single loss incurred. 100% winners, and these aren't small winners. These aren't 3 and 4% winners. These are massive winners. And so I want to go through the track record with you first, and so you can kind of understand the track record, the results, the number of trades that we've done, and most importantly, the results, the rates of return. Obviously, the rates of return are important. And then I'll talk about how I came up with this structure. And when I say I came up with this structure, this isn't anything proprietary to me. It isn't anything specific to me. I'm not the only person out there doing this, but I will tell you that, you know, even if you're a seasoned trader, this is probably a trade that you're going to look at and go, huh, okay, you know, that's a little bit different approach or take on trading. Not something that I necessarily, even if I'm familiar with, I'm probably not doing, okay? And so just to set up the premise of this trade, this is a trade that I was able to put together with a fellow named Jim. There's a trade coming through right there on some E-minis. This is a trade that I was able to put together with one of my compatriots that I work with named Jim Rickards. Jim is a brilliant man. He has just so much information, macroeconomic and finance information stored away in his brain. And these are the kinds of people that you want to surround yourself with, people that have more experience, more knowledge, more time in the field, if you will, than you do. And he certainly has forgotten a lot more about finance and economics than I've ever even learned. And so the idea was he publishes a lot of his content through Paradigm Press, and they wanted to have him put together a program where we focused on bearish strategies, making money in bearish markets. And you know, I love that idea, making money to the downside, shorting stocks, things like that. It's one of my favorite trades, because you guys have all heard the mantra that the stock market takes the stairs up and the elevator down. The big, massive moves are usually to the downside. And also, when you talk to somebody that has lost money in the market, and I say, what's the matter? Did the underlying that you were trading shoot up on you too much? That's rarely the answer. It's almost always, well, no, it fell, it crashed. I got hurt financially because something went down. And so, you know, it makes logical sense that you should have incorporated into your overall investing strategy some way, shape, or form, that you are trading bearish approaches to the marketplace, something that will give you a profit when stuff goes down. And so this is the result of that system. I'll kind of do it a little bit backwards here. I'll go through the results of the system, then we'll talk about how we set this up and some of the challenges that we faced in doing this. So we'll go back to 2019. You can see that, well, there you go right there. June 2018. Or excuse me, June 18th, 2019. So about a year and a half ago is when we started this program. And it is an every other week program. So every other week, basically twice a month, we're doing some research and we are looking for a new trading idea. So here are all of our trades for 2019. You can see the important number is right there. 11 wins, 0 losses, 100% win rate. Now that's impressive, but what is really impressive to me is right here, these annualized rates of return. Look at those annualized rates of return. Guys, this is not chump change. 149%, 205%, 63%, 139%, 70%, 98%, 132%. And you can see the number of days that these trades were held on average. 1 to 2 months, typically, on these trades. So 2019 was an awesome year for us. We're looking to close 2020 out even better. So all of our trades right here are listed for carried over, a couple obviously from 2019 that expired in 2020. I don't know exactly how many of these trades we did. Obviously, well, there we go, right there. There we go. 25 wins, 0 losses, 100% win rate. And you can see when I say 100% win rate, you can see our W trade right here, this Wayfair trade. You can see that we incurred an initial loss of about $1,200 on that trade, but we were able to do 3 adjustments over, what is that, 2 weeks? Yeah, something like that, 2 weeks, and bring in enough to actually move that back into the profit zone. You can see there's all of those adjustments laid out. So we ended up turning a $1,200 loss into about a $600 profit. Now, just a quick note on this. My pitch for what my specialty is, which is adjusting trades. Guys, you're going to have losses. That's not the issue. People always talk to me about, how do I avoid a loss? Stop trying to avoid them. Embrace them. Expect them. Anticipate them. And learn how to fix them. Learn how to adjust them. And that's what we were able to do there. We were able to adjust that trade. So when I say 100% win rate, that's including, obviously, adjusting that trade. We were able to flip it from a loss to a profit. But that was the only trade, really, that we needed to adjust. Going back to January of 2020 and going all the way through the end of the year here, Netflix, which expired on December 18th. That's the last trade that we put through. And again, guys, these are not trivial rates of return. 200% return, 250%, 300%, 360%, 1,300%, 190, 180. Here's a tiny one, 18%. And are you okay with an 18% of your annualized rate of return? That's the worst I think we did. The worst we did all year was an 18% return. 627%, 96%, 132%. It just goes on and on and on. So, I mean, I know it's hyperbole to say that it does not get any better than this, but guys, it doesn't. It doesn't get better than this. If somebody is showing you something that is better than this, and they've done it for a while, they should have millions and millions of dollars, right? Because to be able to compound at these rates of return, it doesn't matter how little you start with. It should be a pretty sizable account. So I'm pretty excited about this. These trades are all documented. We use a company, Alpha Verification. Alpha Verification, that's a third-party auditing firm that we use, that almost all of the Wall Street hedge funds and big mutual fund companies use as well to audit their results. So we know that these are accurate. And so the question then becomes, how do you do this? And so I want to talk a little bit about the challenge that we faced with this and how we overcame that, how I overcame that, essentially. The challenge, of course, is that it is exciting and it is interesting copy, and it is good for marketing to talk about how to build a trading strategy that makes money when markets crash. The problem, especially for the last 18 months when we've done this, is that the market has been in one of the biggest bull markets that it's ever seen. I mean, you guys know what the market's done over the last couple of years. Save for a tiny, tiny, tiny window during the initial stages of the coronavirus, this market's done nothing but just go up, 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 up. So how do you not only make money with things that only go down, but make money with a bearish strategy in a bullish market? Well, The first aspect of this is research. That is one of the first key things. And this is one of the first conversations that gets people depressed. And, you know, if I can just make a salacious pitch for subscribing or being a part of my trading group, this is it. I do a lot of the work for you, or I have a lot of the work done for you. People will say, every time we build a cool trade, how did you find that? And they're very interested, and they are very quick on the draw to ask the initial question. How did you find that trade? When you say, I used this software, this software, this software, this chartered analyst, and this guy to do the research on that, and all of that together cost me about $6,000 a year or $12,000 a year if you add all that software in. Now all of a sudden they become unresponsive, right? You don't get a response back about, oh, where can I go spend that $12,000? So just understand that a good solid trade is making money before you ever push the enter button. A good solid trade has already had a ton of research go into it. And that's what these trades represent right here. They represent trades that have hours and hours and hours and hours and hours and hours of research put into them cumulatively between Dan, my analyst that I work with, Jim, the guy that is the head of this program, and me, the trader that puts the trades together. There's so much work that goes into it. I'm going to give you our secret sauce. I'm going to give you the recipe that we use if you want to look for bearish opportunities in the market. These are the filters that we run. We look for a Z-score less than 2.5. Okay, if you don't know what a Z-score is, now is not the time to break into a 20-minute educational period on what Z-scores are, but it talks about basically the propensity of a company to go out of business. Okay, that's what it's analyzing. So we want to look for a company with a Z-score less than 2.5. Market cap greater than 800 million. We want a big company, so something bigger than 800 million, so that there is still some liquidity in the trade. Share price above $5 a share, and the star mine results, which is a proprietary scoring system. Now, this is a proprietary system, the star mine system. It ranks a probability of default. So it's looking at a company's finances, what they owe in debt, and ranking or scoring them according to probabilities of a default on one of those payments. Okay, and then last but not least, we're looking for a closing price lower than the 10-day simple moving average. So this is giving us an indicator that things are turning over and coming down. That's the criteria that we look for. Now, that's the starting point. That's not the end point. When you start with that, we probably pull up, there's 14,000+ things trading in the stock market on a daily basis. When we run that initial scan, we will, Dan, my analyst, will generally grab maybe 20 to 50 names. And then it's my job to go through those 20 to 50 names and find the needle in the haystack, find the one that meets our best criteria. So let's take a look here at how we've structured these trades to be high probability trades. Okay, so let's walk through a trade example here, and I'm going to use one of our current trades that we are currently actually involved in, and that is CMG. That's Chipotle Mexican Group. This is a trade that we've defined as being overextended too high and ready to come down. And there's a lot of technical indicators that go along with this, as well as all of those fundamental indicators. But let's just say that we believe that CMG, that Chipotle, is going to come down. Okay. How could you play that? Well, we could come in here and we could build a trade. Let's go to, how about we look at our February 19th expiration date options. This is 53 days out. And we look at it and say, okay, I believe Chipotle is coming down. Well, where do you think it's going to come down to? Well, let's come back here to the technical chart. We've done all the fundamental work. We know it meets our criteria. We can see the 50-day moving average here, and we can see how that's acted as a big level of sort of a magnet to the stock, right? Level of support, really a level of consolidation for the stock. So that would probably be its first downward target. That's about 1305. is right that in that range right now, right? So we're at about 1400 right now, price wise. 1305, 1306 in that range would be our downside target. So we could come in here and we could say, okay, I think that this, and if we look here, if we look at the February 19th expiration date, 53 days out, you can look at this brown bar right here. Based on implied volatilities, you can see that that's the trading range expected for Chipotle over that time frame. And the downside is definitely inside of that range. The downside expected move goes all the way down to 1245, right? So let's say that we think that it could get down to that 13, let's say 1310 level. We could certainly just buy this put, right? We could go buy a put option. You can see the numbers here on that trade. It's going to cost us just about $4,000, which seems like a lot of money. But man, look at the max profit potential of this trade. $127,000. That's why people buy options, right? I could put up $4,000 and make $127,000 back. Here's the problem with that. What would have to happen with Chipotle to make $127,000 on this trade? Well, we can look at it in the risk curve, and you can see it would basically have to go to zero, right? It would have to go bankrupt. So this is a 53-day trade right here. What's the likelihood of Chipotle going bankrupt in the next 53 days? Probably not good. Probably not very likely. And that is certainly reflected in our POP right here, our probability of profit. There's no question that there is some tremendous power in this trade. We're putting up $3,900. You can see that's our max loss. That's one of the enticing components of buying options, is you never risk more than your purchase price. So we risked $3,900 to make $127,000. We can see the power of how this trade would work, but the problem is right here. We have a 26% probability of success with this trade. Now, why? When you buy options, why is the likelihood? We understand the profit potential, we understand the leverage here, which is fantastic. But why is the probability of being successful so darn low? Well, there's a lot of things going on inside of this trade that makes it such a low probability of success. Number one is that little flag right there. That's where the current price of Chipotle is. And so we'd have to get down to here just to hit our break-even point. Now, I say break-even point, we're still at a loss there, right? Why? Well, that's step one of break-even. Step two is we got to now cover the cost of the option that we purchased. And so that's why, even though we should start making money right here, you see the risk graph really is down here before we actually start getting into the green. And then last but not least, of course, right here, theta. Theta erosion. Theta is eroding the value of that option. Does it make you comfortable? Does it make you feel good to invest $3,900 into a position, into an option that you know day after day after day is going to lose approximately $63 of value just because of the passage of time, right? And that's what's happening here. So there's all kinds of things working against an option buyer. We get the profit potential, guys. We get it. But you're not going to consistently make money if you're using trading strategies that only work a quarter of the time. Okay? So we're going to move away from that, and we're going to say, you know what? I'm looking at this trade, and I'm looking at the numbers. I like the profit potential, the max profit potential, but I don't think that's real. I don't think that's realistic, that it's going to go to zero. I don't like this. I don't like the lower probability of success, but I really don't like this. Like, I don't want to risk $4,000 on this particular trade. So what I'm going to do, step one in this trade, is I'm going to be less greedy about the results here. And I'm going to say, look, I don't need unlimited upside here in this trade, right? You can see this over and over and over as we run this graph down. The lower the price goes on Chipotle, the higher the profit potential of the trade is. Guys, I don't need this ramp like this. I don't need unlimited profit potential on the downside. I would be willing to sacrifice or cap some of the profit potential on the downside of this trade if there was a way that it would help subsidize the expense or cost of the trade. Okay, so I might be interested in a trade that only works 26% of the time. In fact, I am interested in that trade because it has such high profit potential. But I don't want to put $3,900 into it, right? So what I'm going to do here is I'm going to come back to the table view. You can see right there, there's the put that we purchased. And I'm going to come in behind it here, down 10 points, and I'm going to buy back, or excuse me, I'm going to sell the strike price that is $10 below that, okay? And the minute I do that, you can see what it does to my buying power. Let me take it off. Let's watch that again, okay? So here's the trade. You can see that it's a $3,900 trade. The minute I sell, there we go. Now, instead of $3,900, it's $200. Okay, well, number one, right now, I am much more interested. I am much more interested in putting $200 at risk versus $3,900 at risk. So I'm much more interested in that. But look what else happened. Look what else is interesting in this trade. My probability of profit actually increased. Okay, so I've done a couple of really cool things right here. I have bumped up my probability of success. I have really dramatically lowered by maybe 15 times, you know, my normal risk. Instead of $3,900 at risk, I'm risking only $200. And the reason why that all takes place is because of this. Okay, you can see that what I've done here is I have capped my downside profit by doing that spread trade, and it's a debit spread. By doing that, I have capped my downside potential. I'm okay with that, guys. Look at the numbers and tell me if it still isn't more enticing to you. Max risk is what I put into the trade, which is $200. Max profit, $800. So 4 times, you know, 400% profit potential, 4-to-1 ratio. I'm pretty good with that. I like the leverage there. I like the fact that the probability of being successful on it is a little bit better. Love the fact that I'm only putting up $200, right? So I'm willing to sacrifice a little of that unlimited upside for the downside. But it's still not a great trade in my mind. Number one, still only has about a 1/3 chance of working. And number two, I still got to put up $200. How nice would it be? How awesome would it be to be able to build this entire trade with someone else's money? Build it for free so that you can say, yeah, I get it. This trade only has about a 33% chance of working. I don't care because it's not my money. It's not my money at risk. This $200 at risk, I don't care about it because somebody else gave it to me. Somebody else put it up for me. Okay? So, man, how could you do that? Well, let me show you. We're going to come in here now and we're going to define a resistance level for Chipotle. Now, you can see that the all-time high right here, and this was an all-time high for Chipotle, was about $1,440 a share. So I'm going to come in here. I'm going to look at the expected range of this. The expected range pushes it all the way up to 1560. And what I'm going to do is I'm going to go just outside of this range. And I'm going to sell a $10 credit spread. Okay? But I'm going to do it at a 2-to-1 ratio. 2-to-1 ratio. So I'm going to highlight these. And I'm going to change the number on the quantity there to 2. Now, unfortunately, highlighted one of those put legs too. So let me bring that down back to where it should be. There we go. Okay, so let's recap a little bit what we've got going on in the trade. I have a debit put spread on the downside. Debit, meaning I'm spending money. How much did we spend on that? $200, right? That trade right there cost me $200. So if it costs you money, it's a debit trade. Up here I have a credit trade. Here I'm bringing in money. I'm bringing in income. Okay, so I'm bringing money in on this trade, and I'm doing it in a ratio. So this is a ratio trade. You'll notice that I have only one contract on the put side, two contracts on the call side. So it is a ratio combination trade. I'm combining a debit put spread with a credit call spread in a ratio format. Now, it's not always 2 to 1. Sometimes it's 3 or 4 or 5 to 1. In this case, it's 2 to 1. Let's look at that in the curve now and see what we find. Now you have a very, very interesting setup here. Okay, so you can see the little green flag there. That's where CMG is trading today. Look at the numbers of this trade. If CMG stays, it's at $1,400 a share right now. If it stays below $1,560 over the next 53 days, I make $550. $550 on a $3,400 investment. Is that a good rate of return? About a 20% rate of return in a couple months. It's about 120% a year annualized. Yeah, that's a pretty darn good rate of return. Okay. What are the odds? What are the chances that a $1,400 stock like Chipotle is going to stay below $1,560 over the next couple of months? Well, they're pretty good. Probability of success, 80%. Guys, that's a consistent strategy that you can work with. That's a consistent strategy that you can make money with over time. If you can be successful 80% of the time, that's good enough. Okay. So it's a high probability trade. It's a high profit trade. And then there's just a little bit of icing on the cake. What if we're right? What if we're right and over the next couple of months Chipotle falls below this 1310 level? Well, you can see right there the profit absolutely explodes. It explodes from about $500 in profit to $1,500. It triples. Okay. Now you're making $1,500 on a $3,500 investment. That's a pretty darn good rate of return right there. Okay. So either way, shape, or form, I'm happy with this trade because it is done at a credit. You can see that the numbers are right here. Putting up about $3,500 to do the trade, bringing in about $1,500 right up front in the trade, and that money gets deposited right into my account. So that's the structure, guys. That's the secret sauce. That's the secret recipe for building a bearish trading system in a bullish market where we have not had a single losing trade in the last year and a half. Take care, guys. We'll talk to you soon.